You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks again for having me.
I know people have been watching the equity markets lately where it seems they have 2 or 3 good days, and then they have quite a violent negative reaction and go down. Is this a pattern that we're going to see now?
Well, Jim, back in, when we saw the decline, let me back up one step further. In 2014, we saw the market trying to set up with a top, and it would never happen, and this thing has been stretched and pushed and stretched, and they've just, like I said, the longest extended 4-year cycle ever in history, since the inception of the averages in 1896. And finally in 2015, we started to see things materialize, and one by one we saw, the top that finally happened in 2015. Then we saw the decline that finally happened into the August low. And once we made that low, I said, and I think I said it here, I certainly said it in my letter, that we would see there would be false rallies that would give false hope, that it would confuse the bears and give false hopes to the bulls. And that is precisely what we've seen. We saw the advance out of the August low, and that kind of finished setting things up, if you will. And then we saw the decline down into the January, February low, depending on which index you're looking at. And then we've had this intermediate term advance out of that low. And really, like you said, it really didn't go anywhere till last week, and we had, a week where it was streaked straight up, and now here we are with it trying to roll over. This is an opportunity, like I talked about before, when you come to a cyclical crossroads, if you will, where a top is due or a bottom is due or whatever. It's an opportunity. It's a juncture. It's a crossroads. And that's where we're at. We're at a crossroads where this is an important point where it can turn down. And if this is it, where we get the downturn, then it's going to accelerate again. If it's not, then okay, the advance out of the intermediate term advance is not quite done yet, and something else is going to happen, and it's going to drag on a little bit. But we're at the crossroads now where it can turn and turn hard.
Now, when we say turn and turn hard, how hard is hard?
Hard is, this is the point where it's drug on to the point where hard is, we should, if this is the turn with the intermediate term top, then it should rip. I mean, we should go below, make new lows for the move. I mean, it should go.
Now, is there any one sector that will be picked on, or is this going to be a general decline?
I think it's going to be a general decline across the board. I think it's going to take gold stocks, probably oil stocks, probably everything with it. If this is that juncture that I think it is. If it's not, then okay, it morphs a little bit. That's not double speak. I think that's coming. And I'm just saying this is the juncture for it to happen. And once that intermediate term cycle does top, assuming this is it, it's going to take, I think, everything with it.
Now, is there any timing on this, Tim, or is there the old wait and see?
No, there's that's people that don't understand the markets don't understand. It's about structure. And, I used to hear when I first got interested in the markets, people would say, well, let the market tell you. And I'd be like, well, that doesn't tell you anything. But no, it does. And once you understand market structure, and the structure tells me, like I said, the cycles tell me we're at the juncture. The market obviously is down today, so it's down. But we don't have enough, I haven't seen enough structural development, if you will, and when I say structure, I'm not saying I need to see it down 1,000 points to look back and say, oh yeah, that was the turn. I need to see some short-term structural stuff. I need to see what the overall price oscillator structural picture looks like over the next few days to determine if this is in fact it. If this is it, yeah, it's on. And I think we go down, once this intermediate term cycle tops. If it does top with a left translated structure, that's one of those things I need to see, and this is an opportunity for it to do so, then, we're going below the January, February low and lower, much lower. I mean, and I think in relatively short order.
Now, the Bank of Europe Governor Mario Draghi once again lowered interest rates in Europe. The markets reacted positively to that for about 8 seconds and then started to go down again. Are the days of quantitative easing over, or should they be over?
They should be over. They should have never happened, but that's a horse of a different color. And I think that what this is telling us is that, you know, they've lost, I think they've lost control. They've, you know, everything they're doing, nothing is working here. You know, if you look back at, and I don't remember the dates, but if you look back, you know, the Bank of Japan has done their thing, and, you know, the Fed is, you know, jawboned, and, you know, everybody holds and clings to the Fed meetings, and they've lost their effect. I think they've lost control. I think the market knows it, and, you know, how is a piece of news, if you stop and think about it just logically, what piece of news can come out now and really save or change anything? I mean, does going to a little bit lower interest rate fix anything somehow, mysteriously? No. There's, you know, a piece of news or an action by them at this point isn't going to matter. It doesn't matter. The market's telling us that.
Well, it's interesting. He increased the negative interest rate to 0.4% in Europe. In other words, that's what it's going to cost you to keep your money in the bank. Why would anybody put their money in the bank?
Well, I wouldn't. I mean, if I were in those shoes, and maybe they are, I don't know why. I mean, it's not logical to me. I mean, I would not pay the bank to leave my money there. Personally. I mean, I just wouldn't do it.
Wouldn't that actually lead to a rush to gold because your paper currency isn't worth anything? It's worth less than nothing. I
see your logic, and I think that may be coming, or I think that is coming, but not yet. Not yet. I think we have another push down in gold. This rally, I know everybody got excited about it, but I'm telling you, I really, really, really believe, unless I see something with the structure change as we go down out of this intermediate term top with the metals, I think we have another push down to complete that 9-year cycle low, and then I think it is going to be a tremendous opportunity for gold, but not yet.
In other words, don't rush out and put all your money into gold right now. You may lose something.
Not yet. And I don't know what's going to lead to that. You know, as far as the fundamental news, what sparks the fire, all I know is cyclically, it's coming, but we're not there yet. And maybe it is some problem with the banks. Maybe, you know, who knows? The thing with technical analysis that I've always noticed is you get the setup. And when I say setup, I'm talking about the cycle comes due, be it the top or the bottom or whatever the case may be. You get your DNA markers in place. The structure falls in place. The opportunity presents itself, if you will. And then it always happens. It always, you know, the skeletons come out of the closet, force it to go down, or the positive news comes out, forces it to go up. It just works that way. And like I said, I don't know what it's going to be with gold, but I think it's coming around the corner later this year.
Tim, is one of the problems is that people tend to think very short term. Can I make a profit on this tomorrow or make a profit on this a month from now? But do they think about a year from now, 3 years from now?
I think that this entire bull market process throughout the 80s, 90s, and then the quantitative easing process since 2000 has definitely shortened people's horizon. I think that's a function of greed. I think that's a function of the times, function of the market. So yes, A week to most people is over the horizon. It's just not in their line of sight. And certainly when you start talking months or 6 months or next year, I mean, people just don't seem to think in those terms anymore. And I just think that's a sign of the times, and I think that will change. I think this market will ultimately change that thinking.
Well, somebody said once the problem with instant gratification is that it takes too long.
Exactly. And I think that's where we're at with the market. But look, we've been preaching this stuff and talking about the gloom and doom, and there's for forever. And I don't, I don't just talk gloom and doom because it's not like I have an axe to grind. It's not like, my goal is to be right, not to try to have a side or whatever and just, preach or push an opinion because that's the opinion I chose to push. No, not at all. Not at all. This what people don't understand, and actually in one respect, I think it's somewhat almost discrediting to say some of the things I say, but I stick to the beliefs because of the statistics. And I just want to make it clear that, and I was talking to, let me back up and preface this just a little bit. For example, I was talking to one of the old great technicians, Peter Elides. He and I did an interview earlier this week. And we were talking, he has some long-term views and stuff that he's looking at, and I asked him, we talked about my long-term statistics and what this market, the overall setup is telling me. And we realize, we can't control the fact that it's taking and that there's a force trying to hold it together and that it's taking forever for it to roll. That's all just a product of the environment. Some of it is manipulation. Some of it is the fact that it's dying a slow death because of the psychology of the market has changed. Like you said, people don't see it yet. And so all those things have contributed to it hanging, but the setup's in place. And we're at another one of those junctures. And so I was talking to Peter, and I asked him, I said, so are these statistics or that I have for the what lies ahead? I said, do you think that that's just crazy at this point? And he said, absolutely not, because he sees the same thing. And I asked him, I said, do you agree with me? I said, I'm not putting words in your mouth. I said, but do you agree with me that regardless as to whether or not these statistics come to pass, that until it proves that it's not, that at least that risk is there. It's on the table. It's real. And he said, absolutely. And then I asked him, I said, so the other thing I'd been saying in my letter, because of these risks and these statistics and the extension of this cycle and the environment in which we operate and the fact that people don't see it and so on and so forth, all this, tied all up in a ball, I said, I've been saying in the letter that it makes for, collectively, the most dangerous stock market environment since the inception of the averages in 1896. I said, Peter, do you agree with that? And he said, absolutely. And so what I'm saying is, I guess, I don't know how I got off on that tangent, but the point is that people really don't understand the seriousness of the setup and the potential, the downside potential that we face here. I understand that because they don't do what I do, and it's not choosing a side or trying to sell gloom and doom or trying to be different. It's just fact. It's just statistics. And the fact that the market is held up as well as it has, I say held up, I mean it's not like we're at new highs or anything. It is rolling. It is struggling. I think people can see that. But it hasn't broken down either. But what I'm saying is the fact that it has held doesn't negate the higher degree statistics or the higher degree setup and the associated statistics. This is a very, very dangerous market. And unfortunately, because it's held up, most people obviously don't see it. Once it begins to collapse, then that's going to change. People will run to the other side of the boat. But that's coming, It's coming.
We'll have more with Tim Wood right after the break.
Bird Dog, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Tim, Cyclesman Wood. Tim, just to show how accurate you've been in what you've picked up and what you thought would happen with the markets, I remember when you told me when oil was still over $100 and it was coming down, you said, you know, it's really dangerous. I think it'll hit $30. Maybe it'll be in the $20 range. And I'm sure you received emails saying you've got to be full of it.
You're exactly right. That came out in a letter, after one of the cycles peaked. And, you know, and I did that. There's a study. It's just all of my work. It's just numbers. It's just statistics. And you're right. I made that call based on those statistics. I can tangibly go to that letter and find it and point to that statistic. We're not making this stuff up. The same thing with the top in 2000. I called that top, said that the market would go below the 98 low, gave my reasons why, and it went below the 98 low by 200 points. The extension of the cycle into 2007, people took me to task and said, no, we had a 4-year cycle low in 2006 and we're good to go now. And I said, no, we're not. Because the DNA markers didn't fall in place. This is an extended 4-year cycle advance. They're only making matters worse, and we're going below the 02 low. It sounded nuts. In that case, the setup fell in place. I remembered it. We had a high in July. We went down into August. People thought that was it. I said, nope, we need one more push. The setup was not, the DNA markers were not there. We got that push. They fell in place, bada bing, bada boom. And in that case, the market fell apart pretty quickly. In 2000, it took a while. We had the top in 2000. It really didn't get going until late 2000, mid to late 2001. And then we had the final push in 2002. So that one took a while. With gold in 2008, called that top. Oil in 2008, called that top. All with statistics. The top in gold this last time at the 2011 top. You're reading the letter. I've said every intermediate term advance since that top was in place would be a counter-trend advance, and that gold would go lower. All based on statistics. I'm not saying these things. I'm glad you opened that door. I'm not saying these things about the past calls to brag about the past calls, because like I said, that does me or you no good. It's just credibility. It's in print. It's a fact. It's happened. And the point that I'm trying to make, and I think the door you opened for me here with this, is that it's just numbers. It's just statistics, and this stuff works. And, you know, I don't know. I can't help. I can't control how long the current setup with equities and the situation takes to come to fruition. All I know is that it is. And, you know, I know that we have the setup. I know that this is another opportunity, and I know what the ultimate statistics tell me. And until that's fulfilled or I see something to negate it, that's my position, and I stand by it.
On the oil cycle, where are we right now?
We had a intermediate degree advance out of a bottom, and typically, I'll be 100% honest with oil, it's got me just a little bit confused in one respect. I knew we had an intermediate degree bottom in February, and we've rallied out of that bottom. And we're at another juncture where it too should turn down. But then there's a higher degree cycle that's due. And there's a seasonality aspect to oil. And the seasonality aspect is it typically, and it's not like clockwork. It's not something I can quantify like I can my other cycles. So that's where some of the confusion comes in, is that I know that sometime around the first of the year, seasonal-wise, that, you know, oil tends to make a bottom. It tends to rally into May, June, July, August time frame with the, through the driving time, and then it turns back down. So you have a seasonal aspect with oil, but then you have the cycles, and they do coincide, and you can time it, you can use the cycles and so forth to look at it. And I guess what I'm trying to say with oil is this. I don't know if with the intermediate term bottom that occurred in February, I don't know if that was our seasonal bottom and we're seeing that seasonal bounce yet, or if there's another decline down and then we see that bounce from there. I'm not sure. I don't honestly know at this point. I will say this. I think we're at a short-term top, and again, I hate to use that word because I feel like it's not answering the question, but I don't know until I see what the structure looks like with the characteristics of that decline. When I see that, then I can answer the question. But ultimately, I think that even if this is the seasonal bottom and a high, which would be a higher degree bottom and the February low holds, I think that it's a counter trend bounce and that we at least have another trip back down lower in oil. Ideally, what I think is going on is that we see oil from this short-term top that we have now deteriorate and it goes down with equities and a final flush out. That's kind of what that's my preferred count, if you will. But again, I have to see the structure and what this little decline out of this short-term top that I think we're at now looks like to determine which one of those scenarios is at play.
Tim, because we've seen some decent rallies on the stock markets and with the price of gold, or I should say the price of oil, will that suck people into false hope?
Yes, and I warned about that. That's what I was saying. Back in way back in August, I wrote that. I said that we were going into a low, and that that there would be a multi-month rally, and that it would set people. It would give fuel false hopes for the bulls, and it would serve to confuse the bears, and that's exactly what it's done. We had the rally out of the August low, which failed and moved lower. And then we had the rally out of the January, February low, which I think will fail and move lower, and which I think we're in the process of seeing roll over now.
Tim, anything else people should know right now?
No, I just, like I said, I think pretty much all asset classes go down together when this ultimately rolls. We're in the window for that to happen right now. I know there's been a lot of hype on gold. I want to reiterate, I don't think we're there yet. Yes, there's a little bit of confusion on oil, but I think ultimately it goes lower. And that's pretty much it. People just do not realize the risk, and that's one of the things that makes this market so dangerous, is that it's like the old analogy of cooking the frog in the pot slowly. We had the streak down in August and people spooked. I mean, I remember it. I mean, there was a buzz on TV. We had some, I think we had one of the worst down days in the history of the market, like 1,000 point or over 1,000 point day or whatever the statistic was on that. And people were panicking, man. I mean, that was serious. And then we rallied out of that low. Well, everything's okay now. Everything's fine. And then we went down into the January, February low. There was and undercut the August low on many indexes and retested it on others. There was no panic. It's a slow cooking of the frog in the pot. And that's exactly what's happening. Now we've got this rally and nobody's afraid. The sheep are asleep. And that's one of the many things that makes this environment so dangerous. They don't get it. And what's going to happen, I can tell you now what's going to happen. We get the next shot down, and they're still going to be asleep because they've been trained like dogs. They've been trained. Oh, well, it'll be back. It'll bounce. But when it finally comes apart, it isn't going to bounce. It's going to go. And it's just going to be devastating. And again, that's one of the many reasons why I'm saying this is the most dangerous environment since the inception of the averages.
Tim, thanks a lot for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood. His website, Cycles News and Views at cyclesman.com. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be sent to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.